Hey everyone, welcome back to the channel. This is my third episode of my Magic Formula portfolio series where I'm updating you every single month on my progress in using the Magic Formula as brought to us by Joel Greenblatt from the book, The Little Book That Beats the Market. Every month I add $500 to this portfolio and then make adjustments based on changes to the Magic Formula investing list, which we can see here on the Magic Formula investing site. And this gets regularly updated and you can sort it based on market cap, and then the top 30 or 50 stocks based on the Magic Formula screener will come up. So it's a relative index based on the broader market itself. So these are the 50 most quote-unquote valuable companies compared to all other companies based on the Magic Formula portfolio strategy, which may or may not be super accurate, may or may not be super effective for the future. It's one method of many. I've talked about the basics of the strategy in the previous couple episodes. Go check out the first episode if you happen to be new to the series, where I explain how the actual strategy works and what I'm doing to it. But just a quick wrap, I'm taking the top 50 stocks that are over $50 million in market cap, which is actually the default filter here on magicformulainvesting.com. You can set up an account for free using this screener, and obviously it's not financial advice. Use it for whatever you think it's worth, and it could be a great source of inspiration for stocks for your own portfolio. Maybe you want to try the Magic Formula strategy for yourself or make some tweak to it. This is a great resource to do that. And down in the description, you'll also find a link to the portfolio I have for that particular episode, and you can actually copy it if you use M1 Finance, which is one of my favorite stock brokerages out there. I actually have another M1 Finance series on this channel if you're not already familiar with it, where it's not using this Magic Formula strategy, but rather it's using my own stock picks with my own value judgments as opposed to this more formulaic approach to something like the Magic Formula. But if you want to copy that portfolio or adjust it or whatever, you can actually copy it into your M1 Finance portfolio. M1 Finance is a free brokerage in the US, and you can set up an account for free, so it's worth checking out, and you can use my affiliate link in the description below. That would be fantastic. But also down by that link, you'll also see a link to my Magic Formula portfolio spreadsheet tracker, where I just show what was added to the list versus what was removed, and then how much money I put into each position. So this should help to keep a nice track record of what's going on, in addition to my actual portfolio performance metrics that we'll see in real time. But if you want to back test something like this, this will be useful for that. And I have every single month here. So here's March's list compared to April's, and then anything in green was something that was added that month, and anything in red was removed. And I tried to include all the amounts in there. One I actually missed this month that I meant to add was Fox Corp, as in Fox, the news company, that I somehow missed adding. So that was one that should have made it on. So I'm actually one holding short this month if I was going to be following it exactly. And anything in bold is something that was not actually on M1 Finance, and it's probably over the over-the-counter markets or something like that. It just somehow was not available on M1, so I did not add those. I don't add those because I don't want to pay the extra fee to get those things on a different brokerage. And plus, M1 Finance is just a lot easier to show on something like YouTube, and it's really nice because it automates the actual investing process, which is what I just did today. When I added to this portfolio, I put in an extra $500, and then I hit this auto invest switch, and then it automatically redistributed it into anything that was underweight or did not distribute something that was overweight, and it sold off any holdings, and it keeps everything nice and balanced, since I'm trying to keep everything as equally weighted as possible when I add new money. Obviously, since I don't have 50 holdings exactly, and you can't set a target allocation that's not a whole number, that means that there are going to be some that are at, say, 3% rather than 2% targets. But that is how I'm doing it, and it's very easy to do. I want this to be as easy and as semi-passive as possible, since all I want to do is change the holding each month, let it go, and then let any dividends be reinvested appropriately, and then I can always readjust each month. But back to the spreadsheet, I'll go ahead and highlight what was removed this month. You got AmerisourceBergen, that was removed, pharmaceutical company. There's a large number of pharma stocks in this portfolio. Here's actually a detailed breakdown of all the different industries in this portfolio, and you can see pharma stocks make up a quarter of it, and it's been pretty much that way since I started a couple months ago. I think it was over a third when I first started, so it's coming down a little bit, but clearly a large bias towards pharma, which I'll get back to in a second. But otherwise, we added City Trends, removed Coherus Bioscience, added Dick's Sporting Goods, added Diebold Nixdorf, would have added DLH Holdings, but that was not on M1. Then we removed MCore Group. We would have added Fox, but I accidentally missed that one. Sorry. Then we removed Jazz Pharmaceuticals, removed Legacy Housing Corp, which I didn't really have anyways because it wasn't on M1. added Nature Health Trends, removed Omnicom Group, added Ovid Therapeutics, removed Prestige Consumer Healthcare, removed Tegna, added Trinet Group, added Turtle Beach, which is actually one of my largest holdings over in my other M1 Finance portfolio that's much larger than this one at the moment. So nice to see that. Maybe I'm doing something right in that portfolio. We'll see. Removed Usana, added Viacom, which has been beaten down recently, especially after the Archegos Capital blow up, because Bill Huang was highly leveraged into that stock apparently, and that really hurt. And I actually did a video talking about that whole issue with Bill Huang and all the leverage he was able to get, so you can go ahead and check that out. I'll link that below too. Added Vontier, removed Voyager, and then removed WW International. So that's the updates for the portfolio. Again, I include a link to this in the description. Now, the magic formula is an interesting strategy in that it's a pretty simple approach to a rather simple idea with investing, which is trying to invest in well-priced, higher quality companies relative to everything else. And it does this by weighing two metrics, one of those being return on invested capital, and the other one being the earnings yield. So basically the amount of money the company is making versus what the company is actually trading for. So it's a price metric and a value metric. That's kind of the idea of what it's trying to do. And when you put those two things together, you should get a decent index of high quality, well-priced companies, or at least those that are priced relatively less than what you might get in the broader market. So theoretically, you should be beating the market long term because you're investing in high quality companies at good prices. But like any one strategy, it's not going to be bulletproof in every single environment. Different environments might produce different results. It might lag behind other strategies for even a longer period of time, for many years. I mean, tech stocks and growth stocks have done phenomenal over the last decade compared to would-be value stocks, or at least what we call value stocks, those with more stable earnings, more predictable cash flows. Those businesses haven't really done as well, at least from a price perspective, compared to some high-flying growth stocks, even though they might not have very big profit margins at the moment, if any at all. But the whole purpose of this series is to put this strategy to the test, see how it does in today's investing environment. Especially right now, we got lots of euphoria in tech stocks. Granted, there's been somewhat of a pullback in the last couple months, and maybe we will see a rotation back into value stocks, in which case I would think this index would do quite well. I'm calling it an index, but it's kind of its own little thing. It's a screener, and I'm using the screener to create my own sort of index with it. But this brings me to an interview that my friend Tom over on his channel, Investing with Tom, who is also a member of Punch Card Investing, which is the joint channel that he, myself, and a few others have been doing about value investing in particular. He recently did an interview with Toby Carlisle. Toby is the author of The Acquirer's Multiple. He's also a fund manager himself. And it's almost a direct response to the magic formula investing strategy in that it is trying to find metrics that are indicative of finding good value plays over the long term, maybe not so much relying on return on invested capital, but looking for other metrics as well. But anyways, in this interview, Tom was asking about the difference between the magic formula and why the Acquirer's Multiple might be better than something like the magic formula strategy. So here's what Toby had to say.
Joel Greenblatt takes this sort of combined approach to having some sort of proxy for business quality and some sort of proxy for just cheapness or valuation, and sort of combines the two to do like a quasi, I guess, Warren Buffett style approach, like taking the traditional Ben Graham approach of let's find some cheap stuff and then, you know, adding the quality component on top. And I found it fascinating that just purely focusing on valuation seems to work better. That's sort of what you wrote all about in The Acquirer's Multiple. Do you have a feeling for why that is the case? Like, why doesn't including a return on invested capital or something help with performance?
I really like his approach, and I like the way that he did it too, because he sat back and he said, what does Buffett do? Mm-hmm. How can I simplify that down? Let me try that and see if it works. And then found out that it did in fact work and published those results, which is basically the way I think that this research should be done. Because there's a lot of, computers are so powerful now. Whether you do it via machine learning or whether you're just sort of doing the straight line regression analysis over the data set, you can data mine and find these relationships that aren't real. They just exist because you get a correlation that has no meaning, but they are correlated. So he did the research the right way. And I'm just sort of the kind of person who picks at a scab. When I read the book, it just immediately occurred to me that the way that he does it is he ranks every stock on valuation using EBIT/EV, same metric I use, ranks every stock on return on invested capital. Then he just sums the ranking. So if you got 2,000 stocks and it's the cheapest stock and it's got it gets a rank of 1. And if it's the best stock, it gets a rank of 1. So its combined ranking would be 2. And he does that for all 2,000 stocks. And it just occurred to me that you can have the cheapest stock in the market and it be the worst company on return on invested capital. Or you could have the best company in return on invested capital, and that could be the most expensive stock in the market. And I always understood investing to be, you've sort of got to be finding where the market is wrong in this stuff. And if it's the most expensive stock and the best stock, hasn't the market got that right? Or some combination of that. And so I thought, well, what is the driver of returns here? Is it the cheapness or is it the quality? And when we tested it, we found, and I've done this lots of times in lots of different data sets now, and lots of different countries, and it's always the same answer. Basically, that all of the returns plus more are driven by the value, and the return on invested capital tends to reduce returns. So if you just use return on invested capital by itself, you end up with worse returns in the market because you're trying to buy these better companies, but you're paying too much money for them. So what I have found is that the return on invested capital tends to be picking these companies close to the top of their business cycle. And you just get them when everything has gone right for them. And they're expensive because everybody's recognized that everything's gone right and sort of assume that it's just going to keep on going right. And what happens is they tend to disappoint because they tend to mean revert down. So I think a better approach is buy the cheapest stuff in the market where everything has gone wrong for them. In many instances, they're appropriately priced and they keep on going down. About half the time it's wrong, but at the other half of the time, the market has got it wrong. And buying these positions, and you get a little bit of a turnaround in the business performance, and all of a sudden the stock price rockets up because they've been completely mispriced. And it's that the magnitude of the returns to those ones that work. Even though the frequency is about 50-50, you end up doing better than the market and better than the magic formula combined. The downside to my approach, even though it does tend to outperform over the full data set, is it tends to be a little bit more cyclical, whereas the quality metric or the return on invested capital metric tends to keep you up, helps you keep up with the market through periods of time like we've just gone through. So late 1990s was a similar period where you were better off with some sort of quality metric just because the market preferred better quality companies. And then the value metric held you back. But the value metric did then much better through the early 2000s. Last 10 years have been another period of time where you've been better off having more of a quality focus. But it seems to have flipped again recently, and value seems to be outperforming for about the last 6 to 9 months. So I'm hopeful we've gone back into a value type market, but there's a reason why you might want to use the quality metric too. And that's that it'll help you keep up with the market for these periodic sort of boomlets that we go through.
So a good bit to unpack there. And some of this is stuff we've already kind of gone over in previous episodes, mainly about return on invested capital, in that companies at the top of its business cycle, it just had a great product rollout and it's very short-term spike in its return on invested capital. That's not necessarily indicative of the company actually being great for the long term. You don't really have a moat necessarily if you have a super high return on invested capital in 1 year. That probably explains why there's so many pharma stocks in this magic formula screener at the moment, because if a company just released a new drug a year or two ago, copycats haven't come out yet, well, their profitability looks fantastic, their return on invested capital looks fantastic, but who's saying that's going to last? And the greatest companies are ones that have a much better return on invested capital over the long term. And after looking at the data set, Carlisle says, it looks like that return on invested capital metric actually holds back returns a little bit compared to just focusing on the value or the earnings yield, which is what the other side of the magic formula is. So perhaps if you removed one side of it, you probably would eliminate that discrepancy with pharma stocks being so heavily weighted in it. That would be my guess. I'm not too sure exactly what would happen to the magic formula screener list if you were to remove return on invested capital, only focusing on value. I suppose it would look a lot like a Toby Carlisle fund, but he still did mention that there are some significant benefits to including the return on invested capital metric, at least during some times, mainly those times where people are quickly looking for the quote unquote best businesses. And that's typically indicated by something like a return on invested capital, or how much a company is compounding its own investment into itself. You want to see companies growing, and it's really a growth metric. And when people are looking for those best companies, return on invested capital is typically going to be somewhere in that mix. So in those periods, we kind of had one a couple months ago when there was a little bit of a shift from growth heavy tech stocks into more profitable companies that might have a higher return on invested capital. We saw a little bit of a shift there into value. So I think that's what he's getting at there. When there is that sort of shift, you're not really going to lose out because you're actually going to benefit from people looking for those higher quality businesses. So that quality metric, as he calls it, return on invested capital, could benefit you there. But over the long term, he thinks that value is really what is going to drive things more than return on invested capital. And in fact, return on invested capital might actually hold back your returns compared to just relying on value. But he also mentioned the thing about cycles, and Tom's actually about to ask him about it here. So let's get his thoughts there.
Why do you think it is the case that that approach is so cyclical?
Yeah, I don't know. Honestly, I just think that the market goes through these regularly cycles between euphoria and whatever the opposite of euphoria is, depression. And when it's euphoric, nobody cares about the valuation, really. They're just looking at is this a cool company? Is it doing cool stuff? More than, what do the financial statements look like? But then if the financial statements are also, if it's growing rapidly year on year on year, top line's growing rapidly, most importantly, then those are the sort of companies that attract the attention. And the sort of stuff that I like just doesn't, it's already reasonably difficult stuff to understand. Like, you got to dig into the financial statements and work out which of these are cheaper and which one of these you want to own. And it takes a long time for business quality to sort of out. It takes 3 years to 5 years, I think, for the business quality to be more important than the price that you're paying. So in the short term, it's a voting machine, as they say, and in the longer term, it's a weighing machine. But you can be hanging around for a long time waiting for the weighing machine to work.
And that is the bane of nearly any value investor, in that it's ultimately a contrarian type strategy. You're looking for where the market is wrong. You're looking for where something is being undervalued compared to what you think its actual intrinsic value is. And that can't be true about everything, at least one would think. So it inherently is a contrarian strategy, so it probably won't work the majority of the time. But when it does work, you would hope that it would drastically outperform everything else, and that would kind of pull you forward through the times where it's not working as well, because there's just such a big delta between how much better you'd be doing compared to the broader market in a tougher time, or in a time where there is that shift into value briefly. And as you mentioned earlier, if you have a bunch of bets based on value, ultimately you're going to get something that sticks, and then you get that jump in price after that. So if you get, say, 50% of the time, I think is what the number he said was, 50% of the time if those bets work, they should be much larger than your 50% that don't work. It's just playing the probabilities, essentially. And it's those outsized returns, even if it's in a short window, that really carry the strategy, and that goes to the cyclicality that he was talking about. And if you guys want to check out the rest of that interview, which I definitely recommend, it's a great one, go check it out on Investing with Tom's channel. I'll include a link in the description below, and also include it above right now. But that's all I've got for today. We're up a whopping 5% on a money-weighted return according to M1 Finance, so about $41 out of really about 1,000 that I had invested. The first month was flat. The second month we made a little bit of money, so we'll see how it goes next month with the new $500 I've added to it. We're at $1,550 total on the account value, with about $1,500 total added. But if you guys are interested in the series, want to see more of it, going over this strategy and strategies like it, then definitely subscribe so you don't miss any new updates. I put out new ones on the 28th of every month for this specific series. But if you want to check out my other content as well, I have a lot of stuff about stock investing, real estate investing, and personal finance in general. So again, definitely subscribe so you don't miss out. And if you're more interested in M1 Finance as a platform, I actually have a whole tutorial series going over the brokerage and some of the cool features with it, so definitely check that out as well. But until next time, take care.